Welcome to another stage analysis video. It's Sunday the 22nd of October 2023. I'm going to start off today with the review of the major indexes before getting into the regular content. So with the moment, S&P 500 and the broader market continues to deteriorate. We had a particularly bad week this week, down minus 2.39% in the S&P 500 here. You can see now since the high back in late July, it was the 27th of July, it's been 13 weeks now in a short-term downtrend, pulling back below the 30-week moving average now for a second time now. You can see the 30-week moving average is still rising here, but you can see the deterioration in the broader market breadth down here, which is the combined percentage of stocks above their 50-day, 150-day and 200-day moving averages. So this gives us a really good proxy of what's going on in the market. You see at the moment, this covers the NYSE and the Nasdaq composite stocks, so it's over 5,000 stocks. So really, really good measure of what's going on. And at the moment, it's just over 23%. So it's come off into a very low level, which is normally only seen during a major stage 4 decline in the market. These kind of levels, so it's not often that we get down to such low levels. If you look back onto that, if we go to the monthly chart quickly, you can see that in a little bit more clearly. I've marked the line down here, this current level along here, which is the point of which it's at compared to the other major bear market corrections. So you can see back in 2022, 2020, late 2019, 2015, late 2020, 15, 16 there, 2011, 2008 to early 2009 and 2002. So see all of those major bear markets. So it doesn't seem to tally with what we're seeing in the large cap indexes, but when we look a little bit deeper into the broader indexes and small caps, etc., you'll see that it does actually, because those have been obviously breaking down and moving into the stage 4 declines, and we have a large weighting of those areas in stage 4 currently. It's only a small area of the market which obviously has a larger weighting, which has been holding up. So if we come back to the S&P 500 chart here, as I said, it's been 13 weeks now on correction, and it's now sitting below the 30-week moving average a little bit more convincingly, but it has come back into a zone of support resistance. If we look at the equal weighted chart compared to this, gives us a better idea of what's been going on in the S&P 500 without those weightings. You can see, obviously, year to date here, if we just draw this box across here, you see it's been a very, very sideways market. We're coming back down to the bottom end of the range that it's been in, but we have broken below some levels here. So this zone through here, since late in 2022, obviously been tested a couple of times. We'd have a brief break below that. So potentially the 30-week moving average fairly flat there on the equal weight. This is a potential stage 4 breakdown attempt within here. Obviously not yet clear of the support resistance zone, but it is on the weak side at least here. If we go to the monthly chart, still sitting just under the 30-month and the 10-month moving average here. And as I said, with the percentage of the stocks down at a very low level at the moment. We go on to the daily at the bottom of the current downtrend channel. That's obviously started since that top there, which was, as I said, 27th of July. It's where we made the top. So at the moment, testing the bottom end of the range and the 200-day moving average. And you can see it's below its minus 1 ATR level currently, sitting just above the minus 2 ATR level. Percentage of stocks above their 20-day EMA in the S&P 500 is down to just 15.2%. So back into the lower zone with this. I talked on previous videos that when we get a move out of the low zone and up through the 30% level, what you would expect to see if it was a move back to a bullish position is a strong thrust straight back up into the upper zone without any pullback. So the fact that we started to pull back in here did suggest that it was fairly weak and was potentially going to roll back over again for a further test. So we're seeing that currently hasn't yet broken down to the downside in the S&P 500 itself here. If we look at the equal weight, it's a little bit lower, has broken the bottom of the structure, but there is a short-term base structure developing on both of these. You can see the same structure on the S&P 500 itself, just testing the lower end of the range of that. So still in a position where it could be attempting to form a short-term base. Obviously, it's in a dangerous position. do have lots of significant earnings coming up this week. 5 of the Nasdaq 100 biggest holdings reporting this week. I think they make up percentage of that makes up over 20% of the actual index itself. We've got Meta, Google's, Amazon, and I can't think of the other one off the top of my head, but they're some of the major ones reporting this week. So basically, this is in a very dangerous position, but also with those large caps reporting, they could obviously put in a defined swing low if they have positive reactions to those earnings results with such large weightings in the indexes. But obviously, poor reactions could send this into a waterfall decline, and we could see breakdowns and get with more stocks getting closer to stage 4 levels. So at the moment, the Nasdaq 100 sitting on the borderline of stage 3 at the moment, just sitting above its rising 30-week moving average still. You can see the percentage of stocks above their 200-day moving average has dropped down to a very neutral 53% at the moment. So you can see I've marked this with the bluey grey box through here. So the 60 to 40 zone through here is the neutral range. So anything between those, so it's in a more in equilibrium as such. So it could still rebound from here. Obviously, it could break down significantly. But if we look at this from an equal weighted perspective on the daily, you can see it's below its 200-day moving average on that. So a little bit of a weaker position compared to the actual Nasdaq 100 chart here, which is still 4 or 5% above its 200-day moving average. So we could potentially see a flush down to that 200-day moving average. Obviously, wouldn't be surprising as they try to get liquidity and try and flush people out of the market for a Q4 rally, as people are hoping for. They may not get it, but at the moment, still sitting at the weaker end of the range, at the bottom of the range here. Obviously in a short-term downtrend, so I'm below that minus 180R level as well within this structure. Go to the Nasdaq Composite, also stage 3 now. It's had a few weeks where it's tested below the 30-week moving average and now moved below it a little bit more convincingly this week. So you'd want to see a quick recovery, ideally, if it's going to still hold up and chop around in stage 3 and potentially recover back to stage 2 again. There is a wedge formation on these, so on the Nasdaq 100 and the Nasdaq Composite chart, so could potentially squeeze back out of this again and make a stage 2 continuation, but obviously further weakness through here would be quite damaging. It's down to only 21% above their 200-day moving average in the Nasdaq Composite, still a little bit above its 200-day moving average, so that's a potential short-term target which would break it below the bottom of the range here and get people a little bit more excited. So on the short side, percentage of stocks above their 20-day at 16% at the moment. So again, in the lower zone, need to see this rally strongly from the bottom zone to the upper zone in a single move in order for a change of behavior. NYSE continuing to weaken here. Again, year to date, it's gone very much sideways. Had a few failed breakout attempts early in the year, and then the failed stage 2 attempt in late July there before topping out and rolling over again. So it turned into a UTAD type move. So if we look at the base structure, broader structure through here, wherever you want to draw it, it's basically been in a range, and it's near the bottom end of the structure, not as far down as the S&P 500 equal weight there, which was obviously breaking below these levels, but still obviously at the lower end of the range and showing some near-term weakness, which it's continuously weakened since that July top from almost 70% down to just 31% above their 200-day moving average at the moment. So very, very weak, as we've seen from the combined breadth. Look at the Russell 2000, same kind of thing. We're seeing breakdown, potential move back towards stage 4 here. This technically could be a stage 4 breakdown. It's still got older support back through this area, so could still recover from here. But it is obviously one of the lowest closes it's seen, the lowest close it's seen of 2023 there on a weekly basis. It's had multiple failed attempts to pop out into stage 2 earlier in the year, which have rolled over again. So this needs to recover quickly, potential for a spring if it does, but if it doesn't, then obviously would be a further sign of weakness and would obviously keep you out of the market or on the short side for longer. Daily chart, you can see that breakdown a little bit more clearly. Still got this March low level, which is just coming down to as well. So bigger volume on that move down on Friday there. So they didn't manage to break below that level with that heavier volume there. Percentage of stocks at 15.67% above their 20-day moving average. We use the S&P 600 small caps for this on stock charts, as they don't have it for the Russell 2000. So the S&P 600 small caps is a good enough proxy, in my opinion, for when you want to look for the small cap breadth. Look at the VIX, did actually spike above on Thursday and Friday, the recent pivot highs. So obviously the most it's been above its 200-day moving average for a while. I think it's 23% above that 200-day moving average. So at the moment or so, 24, 25. I think we did make similar moves back in March where it got around 25, 26% above. But on a closing basis, it's the furthest it's been above its 200-day moving average. So in a weak position at the moment, so you need to see a quick reversal back to the other side if bullishness is going to return. But at the moment, obviously, it's very much a risk off at the moment. Going